Good evening, sir.
Please confirm you can hear me clearly.
Good evening, sir. Can I hear you, sir?
Oluwatosi. Tonight, we are looking at financial management. By way of introduction again, my name is Asiwaju. Together with Adejuwon, I shall be taking you some aspect of financial management. I'm aware financial management class started on Monday. So I want to assume that the lecturer Adejuwon has done an overview of financial management. Having said that, allow me to do a small introduction of the paper financial management. What is the expectation? Or what are the expectations? Mr. Shekoni, please avoid touching my screen. At any point in time you touch the screen, there will be a mark on the screen. All right. Financial management is an aspect of management. It's a component of company's management that focuses on how companies source finance. How companies utilize finance for the purpose of meeting the objective of the organization. Let us explain that. We said financial management. A critical aspect of management. A strategic aspect of management that deals with how companies source finance. That means, as a financial management student, you must understand the various sources of financing. How can company raise finance? You must understand the different types of financing available to businesses. Now, if you understand the different types of finances, you must understand the cost of financing. Every financing method has an associated cost. If you finance your business with equity, there's what we call cost of equity. Cost of equity financing. If you finance your business with debt, there's what we call cost of debt financing. That means, as a finance management student, you must understand how to determine cost of financing. This is the topic Adejunwa is taking you guys. How can we determine cost of financing? As a rational business person, to finance your business with that method that is cheaper, that method of financing that will minimize your cost of financing. You can appreciate the topic Juan is taking you. How can we determine the cost of capital? The cost of capital finance. Now, if you understand how to source finance, if you understand cost of financing, then you must ask yourself, how can you utilize the finance to achieve the objective of a business organization? There's one thing to source finance. It is another thing to know how to utilize finance. That is, you must be able to invest the money you have generated. You must be able to invest money generated from financing in such a way as to meet the objective of the organization. That means as a finance management student, you must understand investment analysis. The investment analysis will tell you how you can invest your money to generate returns. Next, remember we are doing an overview. If you understand investment analysis and the company generates profits, the next question is, how do we distribute these profits to the stakeholders? How will the profit generated be distributed to the different stakeholders? That would lead you to dividend policy. What percentage of the company's profits should be distributed as dividends? What percentage of the company's profits should be retained and reinvested in the business? That means as the lecture progresses, you are still going to get to investment analysis. You are still going to get to dividend policy and retention policy. Again, you must understand the management of financial risk. Every business decision involves element of risk. Every financing option involves element of risk. That means at a later period, we are going to be discussing risk management. All right. We have tried to explain the overview of the paper financial management. Now let us narrow down to topics. Tonight, we shall be treating business financing. That is sources of finance. Tonight, we are going to be treating business financing. We shall be looking at the different methods of financing. All right. Like we explained, an important aspect of financial management is the choice of the method of financing. It means assets. An important aspect of financial management is the choice of the method of financing available to companies. Companies utilize a variety of finance sources. Companies use different types of financing. And the objective is to achieve an efficient capital structure. Let's take that again. You may ask yourself, why do companies use different types of financing? Equity financing, debt financing, preference shares, bank loan, venture capitalists. You can ask yourself, why do companies use different methods of financing? Why not stick to one financing? The objective is to achieve an efficient capital structure. All right. What are the various forms of financing? We shall be discussing short-term financing, long-term financing, our discussion of source of finance. We are going to look at it under two major headings. Short-term source of finance. Finance available to company with a repayment period of 1 to 2 years. Short-term finance sources. These are finance sources with a maturity period of between 1 year and 2 years. Short-term financing. What are these financing? One of them is bank overdraft. One of these is bank overdraft. Bank overdraft is a short-term debt financing. They just 1 minute. All right. Bank overdraft is a short-term debt financing. A company can arrange a bank overdraft to finance its need to finance its short-term operational needs. A company can arrange a bank overdraft to finance its short-term operational needs. Overdraft facility can be negotiated with a bank, which allows the company to overdraw its accounts up to an agreed limit. In other words, companies can utilize overdraft as a source of financing. You can approach a bank to negotiate overdraft facilities. This facility will allow you to overdraw your accounts up to agreed limits. All right, please listen to this. What are the features or characteristics of overdraft? What is the uniqueness of overdraft? The uniqueness of overdraft facility. Please note the following points. Overdraft facility can only be used to finance short-term operational activities. In other words, you cannot use overdraft to finance long-term projects. Overdraft facility cannot be used to finance long-term projects. That point should be noted. Point number 2. The overdraft The company's bank balance is expected to fluctuate regularly between the deficit units and the surplus units. Under overdraft arrangement, the company's bank balance is expected to fluctuate regularly between the deficit units and the surplus position. This implies that overdraft facility, the overdraft bank balance, must not be kept at a permanent position. The bank balance should fluctuate regularly. You cannot take an overdraft and you now kept the balance at a permanent position. That account is an operational account. So we expect the accounts to have inflows and outflows, regularly. Then lastly, the bank has the right to call in an overdraft facility at any time. The bank has a right to call in an overdraft facility at any time. And the bank might do this if it is believed company is not managed very well. Of that last point, facility, a very risky source of to repay the amount borrowed under overdraft with the shortest notice, and the customer must oblige. Right? So please note, examiner can ask you, examiner can create a scenario that a company needs to finance a project. Recommend appropriate financing for this company. Before you can recommend, you are going to ask yourself, is that project a long-term project or a short-term project? If that project is a long-term project, that means you cannot recommend bank overdraft. All right. Number 2 method, short-term bank loan. Companies can also arrange short-term bank loans to finance a specific project. Unlike overdraft facility, a bank loan is for a specific period of time, and there's usually a repayment schedule. You can approach a bank to take loan on short term. There's going to be a specific repayment period. Hence, bank loan can be used as a finance. This will fall under debt finance. Number, it can also be used as a source of debt finance. You can use trade credits as a source of debt finance. A company can negotiate a favorable trade credit with or from its suppliers. You can obtain financing through trade credits. You can discuss with your suppliers to buy the goods on credits, and you pay at a later period. You can negotiate with your supplier to take raw materials or to buy raw materials on credit. This raw material will be used for your production. When you make sales, you pay back, you pay the supplier of raw material. So company can adopt trade credits as a source of financing. Number 4, debt factoring. Debt factoring. What is debt factoring? How does this work? Debt factoring, under this method, companies that use debt factor to collect their receivables, the trade receivables, might obtain financing from the factor. You can obtain financing for your trade credit from the debt factor. One of the services offered by a factor is to provide finance upfront up to like 80% of the value of trade credits the factor has undertaken to collect. Let us explain that briefly. Who is a factor? Let us explain that briefly. Who is a factor? A factor is a paid agent commissioned to collect trade receivables on behalf of its clients. A factor is a paid agent that has been authorized to collect trade receivables on behalf of its clients. A factor could be a company or an individual. Now, one of the services offered by the factor is that the factor can provide finance for you as against the trade receivables he or she has undertaken to collect. That means company can obtain financing from the debt factor. Remember our topic tonight. How can companies source finance? Our topic tonight is how can companies source finance? Then lastly, under short-term debt financing, we have operating lease. Operating lease might be used. Operating lease can serve as an alternative to obtaining short-term financing. There's a question for us. What do you mean by trade credit and bank loan as debt financing? All right, quick one. When we say debt finance, debt financing is borrowing. If you go to bank to borrow money, that will be categorized as debt financing. Also, trade credit is also borrowing. You approach a supplier, you buy good on credit. Technically, by buying good on credit, you are owing that person money. The person has allowed you to take raw material on credit. In the company's book, you are part of the debtors. Is that better, Oluwaseun? Oh, Oluwakemi. Is that better, please? All right. Question from Coyote. I don't understand debt factoring. All right. I was expecting that anyway. I was expecting that somebody will answer that question. Okay, let us illustrate this. Please feel free to ask questions. Oh. Let us illustrate debt factoring. Just 1 minute. Let me take my pen. All right, let's continue. Let us illustrate debt factoring now. Thank you, sir. Sorry, I'm trying to get my electronic bulb. Now look at it. Let us illustrate debt factoring. You have down.
Can't hear you. I don't know if I'm the only one. Sorry, sir, I can't hear you.
There was a network glitch. But we are back. Let's continue our illustration. All right. We said Dangote Cement sold cement on credit to a customer, amount 500 million. The customer is to pay back in 6 months' time. The customer will pay us, we pay Dangote this money in 6 months' time. In the book of Dangote, this transaction will be recorded as trade receivables. Is that not, please? We have sold goods on credit. In our book, this amount will be recorded as trade receivables, 500 million. Now, Dangote can decide to outsource the collection of trade receivables to an agent called factor. Dangote can decide to outsource the collection of these trade receivables to an independent person called a debt factor. Please, can you see this? A debt factor is an individual who has been given the responsibility to collect trade receivables on behalf of the company. Now, one of the services offered by the factor is that it can provide finance to the company upfront. In this case, the factor can provide finance for Dangote now. That say, okay, I'm to collect this money on your behalf in 6 months' time. I can give you this money, like 400 million now. The factor can provide you with that money up to like 80% of the money. That means Dangote as a company can obtain financing from a factor. A factor who has been authorized to collect trade receivables on behalf of Dangote. Remember the discussion tonight. How can company source finance Free trade receivables now, customer. The network page. So what we are saying is, for companies led trade receivable, such companies can obtain financing from the factor. Is that better, please? Mr. Kennedy, is that better, please? All right, thank you, Kennedy. Oluwatosi. The network is logging you out. As much as possible, let me advise us. Nobody has control over network. Occasionally, it will happen. It can happen to the lecturer. It can happen to any student. We can only hope that the impact will be minimal. Oluwakemi, yes, I can help you now. Oluwakemi, please speak up. Olukemi, Oluwaseun, please speak up. Your hand is up. Okay?
Sorry, sir, it's my network. Can you hear me now, sir?
I can hear you
Sorry,
slightly.
the debt factoring we are talking about. So from this scenario
The debt
now,
factory, yes.
the 400 million paid by the debt factor in advance. So does that mean the factor will not have anything as commission, or it will pay the remaining back to the company?
Does it mean the factor will not charge any interest? That way I'm saying.
Yes, sir.
Of course, there's going to be legal arrangements. There's going to be charges. Do you understand? There's even element of risk. If the factor should give Dangote 400 million immediately against 500 million to be collected in 6 months' time, what happened if the customer died and nobody to pay the money back? What will happen? You can see that there are risks involved in financing. There are costs involved in financing. You are still going to treat it as a topic under working capital management. When you are talking of the debt factor, the arrangements, the cost of debt factory, the interest on debt factory, the topic, this will still be treated as a topic under working capital management. What we are discussing tonight is how can companies source finance? Is that better, please?
Thank you, sir. Right on, sir.
All right, so may God keep us alive and in good health. You are still going to take it as a copy. For those that sat for the exam last days, that was question number 4. Working capital management. I think question 4 or 5, I'm not sure now. Or question 2, but one of the questions was working capital management. They were asking us question on cash operating cycle. All right. Now the last one, operating leaks. We said operating leaks might be an alternative to obtaining short-term financing. Operating leaks or operating leases are similar to rental agreements. A rental agreement for the use of non-current assets, usually for a short period of time. Operating lease. If you are trying to buy an asset, okay, you are trying to obtain an asset. You don't have the money to buy the asset. You want to buy an asset for your business, but you don't have the capital to buy the asset. You can go into operating lease, equipment, or the asset, and you only pay annual rental fee. Companies that obtain the use of non-current assets with operating lease agreements. If you obtain an asset under operating lease, you avoid the need to purchase the asset. You avoid the need to purchase the assets and to finance the purchases with capital. That means you don't need to go and look for money to buy the assets. You can enter into operating lease, whereby you are going to be paying lease rental every year. Excuse me, please. Operating lease might be used extensively by small and medium-sized business enterprises. This is very common in engineering sector. Engineering firms that cannot buy the equipment, you can arrange for leasing. You can lease the equipment. You only pay lease rental. In other words, unseen. Term debt financing. The next explanation. Sources of long-term funds. The sources of long-term finance. Any question again? Any clarification? All right, so let's go to it. When we say long-term financing, financing required for long-term assets and for financing working capital. Finance needed for long-term projects. This finance include equity financing, long-term debt finance, this finance include equity financing and long-term debt financing. Let us start with equity source of finance. What is equity financing? Finance provided is categorized as equity financing. Finance contributed to the business by the owners of the Please, let's get on with the class. We are discussing equity financing. Finance contributed to the business by the owners of the business. The owners of the business are the shareholders. The owners of the business are the equity shareholders. What are the sources of equity financing? And please note, equity financing is a long-term source of financing. What are the sources of equity financing? One, retained earnings. Retained earnings. Your retained earnings is part of the company's profit that is retained in the business, not distributed to shareholders in the form of dividends. Retained earnings. Retained earnings is that part of company's profits that is retained and reinvested in the business. Arises. Company can utilize retained earnings as a source of financing. Retained earnings can be adopted as a this finance this finance is readily available. In other words, the directors do not require the approval of the shareholders in order to utilize retained earnings to finance the business. I will advise you to check your network gift. You may log out and log in.
The network is fluctuating here, but I think it's on your end.
All right, so please note, retained earnings can be used as a source of financing. And this is categorized as part of equity finance. Next, still under equity financing, issue of new shares. Under equity financing. Company can issue new shares so as to generate finance, so as to generate financing. There are three methods. Okay, let's continue. There are three methods of issuing new shares for cash. There are three methods of issuing new shares for cash. One, offer for public subscription. Offer for public subscription. We call it public offer. This is a situation where new shares are issued to the general investing public. Under public offer, the company in question issues new shares to the general investing public with an objective to source finance. But please note, public offer can only be done by publicly quoted companies. Please note, public offer can only be done by publicly quoted companies. Private companies are not allowed by law to issue shares to the general public. Please note that. Also note, public offer is usually used where the company is planning to raise substantial amount of money. A substantial amount of finance. That is one method of issuing shares, issuing new shares with a view to sourcing finance. Number two method, private placing. We call it placing or private placing. This is the issuing of new shares to a relatively small number of selected investors. Placing. The issuing of new shares to a relatively small number of selected investors. Private placing of new shares. This method can be used by both public companies and private companies. Private placing. The shares, the new shares will be placed privately. This will not be communicated in the news to the general public. You can now ask yourself, at every point in time, you are going to be querying what you are reading. Why will a company prefer private placing or public placing or public offer? Sorry. You know, we said public offer is preferable if a company is planning to raise a substantial amount of money, because the associated cost is higher. When it comes to private placing is used where a company is planning to raise small amount of money because the associated cost of private placing is cheaper. But you must also know what are the risks involved. When a company embarks on private placing, you shares to a relatively small number of investors. That can give rise to dilution of shares, and that investor will now have major control in your business. That is risky. So if a company takes private placing, although the cost is cheaper, but there's the element of, there's the risk of change in ownership, dilution in ownership and control. The majority shareholder will always control the company. Then the last one, we have explained public offer. We have explained private placing. Number 3, right issue. Please, just 1 minute. I will take your question in 1 minute. I want to remove this pen. All right, let me look at the question or the comments. All right, Rosemary, please explain dilution. Dilution in ownership and control. Okay? Assume that means to come in. You now issue the shares privately. A single investor can buy the whole shares. Ownership structure will change. See, let me try and illustrate this. What we call dilution. Okay, let me create space. Let me create space. You have A, B, C. PSC. Let's go on. Assuming company ABC PSC has 3 shareholders. This person owns 40%. This person owns 30%. This person owns 30%. The company now decided to issue new shares. Decided to issue new shares through placing now. You are issuing new shares. New shares via placing. One shareholder can buy the old shares, assuming the new shareholder now bought over the old shares. Because you have done private placing, by buying this new share, this person might acquire, say, 45% ownership. In this case, maybe this one now moves to 15%. This person moves to say 15% also. This person is 25. A new shareholder now coming because you have issued new shares. Shareholder D now control 45%. You now observe that the new shareholder now has acquired 45% ownership in your company. There is dilution now in ownership. This new shareholder will have the major power to determine anything in the company. Whenever they want to speak, all of them, they will notice that the new shareholder D has a strong voice. By issuing new shares to a small number of selected investors, there is the risk of dilution in ownership. Is that better, please? All right, let's go on. Then we have rights issue. Rights issue is also source of equity finance. What is rights issue? Issuing of new shares to existing shareholders in accordance to their shareholdings in the business. We said rights issue. The issuing of new shares to existing shareholders in accordance to their existing shareholdings, usually at a discounted price. Company can do rights issue. You are issuing new shares to your existing shareholders, additional financing. The objective of sourcing additional financing under rights issue. You are now issuing new shares to your existing shareholder at a discounted price. This discounted price is called the issue price. The issue price of the new shares in a right issue. The issue price of the new shares in a right issue should be lower than the current market price of the existing shares. The issue price of the new shares in a right issue should be lower than the current market price of the existing shares. So as to encourage the shareholders to take up their rights and subscribe for the new shares. Excuse me. You are trying to encourage the shareholders to subscribe for the new shares by issuing the new shares at a reduced price. Please note, when we say rights issue, the company has shares in existence, and the existing shares has a price at the stock market. That price at the stock market is called current market price. Please note this. This aspect is a bit sensitive, and it requires a clear explanation. You have the nominal share price. That is the price in the balance sheet. Nominal share price. That is the price you are going to see in the statement of financial position. You have the stock market price. That is the current market price of the shares. Of the existing shares. If you observe, for some of us that watch channels news, in Nigeria of today, we pay attention to our phones. We watch news on our phone than sitting to watch the full news. Anyway, the phone also enabled to show the news anyway. If you observe channels news or any news, towards the end of the news, they will now give us stock market reports. That stock market report is the market price of the shares. And please note, only quoted companies will be represented there. So you have market price. Now, if the company is now issuing new shares to existing shareholders at a reduced price, that reduced price is called the issue price or the rise price. Next, still under right issue, we have what we call the theoretical expiry price. There's what we call the theoretical X right price. All right. I'm trying to take it cool now. This was tested last diet. Right. When a company announces a rights issue, when a company announces a rights issue, the market price of the existing shares is called cum rights price. When a company announces a rights issue, the market price of the existing shares is called cum rights price. Full stop. The theoretical strike price is what the share price ought to be after the completion of the rights issue. The theoretical S price is the estimated share price following the completion of the rights issue. The expected share price after the completion of the rights issue. This is calculated as the weighted average price This is calculated as the weighted average price of the current shares, the weighted average price of the existing shares, cum rights, and the issue price of the new shares. This will come for calculation, no? But not tonight. When we say theoretical strike price, recall, let me try to illustrate small thing here. Diet in diet to be your exam. When we go back, go and pick last diet question. If you are going to see there, it was the number 7 question. Last diet. So let's try to illustrate this. When we say theoretical strike price, okay? we said right issue. Under right issue, you have existing shares. Existing shares with market price. We now have new shares at issue price. Let us assume the market price here is 30 naira per share. The issue price is 25. This is the price at which the new shares are issued. You are now asked to calculate the theoretical expired price. That is the expected share price after the completion of the right issue. You are going to look for the weighted average here. You are going to calculate as the weighted average. Most likely the price will now go to say like 27 naira. The weighted average of the existing shares share rights and the issue price of the new shares. At the end of the day, you are going to have an average, which is likely to be like 27. Chiamaka, you just coming in. Because this class we have spent 1.5 hours. And a student is asking me, what is the topic? So maybe the student is just coming in. The topic is sources of finance. So my assumption is Chiamaka is just coming in. All right. To round up on right issue, please remember or please note, under the right issue, the shareholders has a choice whether to buy the new shares or not. Under right issue, the existing shareholders has a choice whether to subscribe for the new shares or not to subscribe. Under the right issue, there are 4 options available to the shareholders. What are these options? The shareholders can decide to take up their rights and buy the new shares. Option 1, the shareholders can decide to take up their rights and buy the new shares. Option 2. The shareholders can decide to renounce their rights and sell the rights to the stock market. You can decide to renounce your rights and sell the rights to the stock market. By selling the rights, the shareholder is selling to another investor the right to subscribe for the new shares. You can sell your rights to another investor to subscribe for the new shares at the issue price. Option 3. The shareholders can take up some of the rights and renounce some of the rights. That is, the shareholder can buy some of the rights and sell some of the rights. Option 3 is a combination of option 1 and 2. Then the last option. The shareholder can decide to do nothing. You can ignore the rights. You can ignore the rights completely. That means you are not taking any action. But please note, the shareholders is likely to suffer a reduction in investment value if they decide to ignore the rights. Right. We are done with equity financing as a source of long-term financing. Any questions so far? Any clarification?
Please, sir, I have questions. Sir. I'm so sorry for not raising my hand.
Yes, Oluwaseun.
Sir, I asked in a chat, like you didn't say it. Is retained earning the same thing as a plowed back profit?
Can somebody hear, please?
Oh God. I said, is retained earning as the same as a plowed back profit?
A plowback.
Yes, sir.
Yes. Of course, that was the elementary terms we use in commerce, Abi. Plugging back part of your capital.
Yes, sir.
It was the elementary terms under commerce. Okay, so it's technically retained earnings. You are plugging back part of your profit to the business.
Okay, sir. My second question, sir. The private placing, is it to the existing shareholder or the new shareholder?
Which one is that?
The private placing.
Private
Is it
placing.
to the existing shareholder?
No, please. Private placing is the issuing of new shares to a selected investors. These investors may not be the existing shareholders. Anybody can buy it.
Okay.
When we say
Thank you, sir.
private placing, okay, let me explain further.
Yes,
When
sir.
we say private placing, what happens is that the company will issue the shares and give the shares to an issuing house or a stockbroker. You are not going to announce to the public. When you now issue the shares, you place it with a stockbroker. The stockbroker will now look for buyer. The stockbroker will not announce in the newspaper or in the television. It will now look for buyer. Anybody can buy it. Is that clear, please?
Yes, sir. Thank you, sir.
But when it comes to rights issue, you are issuing shares to existing shareholder. That is the technical term for rights issue. In this case, unless the existing shareholders are not buying, that is when you cannot issue to public. Unless the existing shareholder says we don't want to buy, then you cannot be taking the shares to other investors. It is the right of the existing shareholder to buy at a reduced price because that price is cheaper. Is that better, Kemi?
Thank you, sir.
All right. We have like 45 minutes to round up the class. Let us look at long-term debt financing. Like the question that was asked. Why do we say debt finance? Debt finance refers to all forms of borrowing. Anytime a company goes to borrow money, that finance will be categorized as debt financing. We have long-term debt financing, medium-term debt financing, and short-term debt financing. Recall, short-term bank loans, debt factoring. Now let us look at long-term debt financing. Company can issue bond and instruments that can be used to borrow money. A debt instrument, a bond, is a debt instrument that can be used by companies to borrow money. Dangote can issue bond to the public. Public will now subscribe. Company can, public, the individual public can subscribe for this bond. We also have debentures, long-term debt finance. We also have loan stock, bond, a debt instrument that can be used to borrow money. Loan stock, also a debt instrument that can be used to borrow money. Debentures, debt instruments that can be issued to borrow money. Ooh. We have medium-term debt financing, long-term bank loan, long-term bank loan of 5 to 7 years maturity. These instruments can be used to borrow money with an objective or with a view to sourcing finance. What are the peculiar characteristics of debt financing? Or what is the uniqueness of debt financing? Remember, we said debt financing, all forms of borrowing. This borrowing could be long-term or short-term or medium-term. Debt finance might be secured against the asset of the borrower. If a company is planning to borrow money, the lender can ask you to produce a collateral, an asset you are going to use as a security for the loan. In that case, that debt finance is secured against the asset of the borrower. That means if a company is planning to borrow money, you have to ask yourself, do you have non-current assets that can be used as collateral for the loan? Also, when a debt is secured, the lender has the right to seek repayment of the outstanding loan out of the secured assets. If the borrower fails to make payment of interest and repayment of the capital, the lender can go to the assets and recover the amounts lent. The secured asset provide a second source of repayment if the first source fails. So that can tell you that when a company borrows money, the lender can take over your assets. You begin to appreciate the risk involved in debt financing. When a debt is not secured, the lender does not have the second source of repayment. That's number 1 point. Peculiar characteristic of debt financing. Number 2, the borrower is usually required to give certain undertakings or covenants when you are talking of debt financing. There are conditions attached to the debt finance. These conditions must be complied with the borrower. In full, what is that full? We got to move. The borrower will be in default for any breach of covenants. If the borrower breach any of the agreements, the lender has the right to take legal action against the borrower. Under equity financing, shareholders cannot take legal action. The highest you can do is to sell your shares and leave the company. The bottom line is that when we say straight debt, a debt with a fixed amount of repayable instruments at a fixed interest rate. The bottom line is that these debts can be used to source finance. Convertible debt Oh. Debt instruments that give the debt holder the right but not the obligation to convert the debt instruments into equity shares. Debt instrument that can be converted to equity is a right of conversion, not an obligation. Company can issue convertible debt finance with a view to sourcing finance. Oh. And please note, all debt financing comes with interest elements. The borrower will be required or will be expected to pay interest. And please note, the interest payable is liable for tax purposes. That means if you pay interest on your debt, you can claim tax relief on interest payable. The tax relief can be used to reduce your cost of borrowing. This is the reason why debt financing is cheaper. This is the major advantage of debt financing. It can be used to reduce your cost of borrowing. Reduction in your cost of borrowing will enhance the company's profits and value. Any question, please? Let's take, I don't want to solve any question today. The time is first pains. Let me see. We have discussed equity financing, short-term debt finance, long-term debt finance. Let's see if we can discuss Islamic finance. Within the 30 minutes, let's see if we can discuss Islamic financing. If you look at the Nigerian financial system, in the last 10 years, we have seen Islamic financing growing in Nigeria. In UK, Islamic finance is taking over. Even in Europe, so in the last 10 years, if I'm not mistaken, we started with Jaiz Bank. So we have Tajid Bank, we have Lotus Bank, we have Summit Finance, recently we have Etika, a digital Islamic finance banking. Just like you have OPay, Money Points. In recent time, we have what we call ethical finance, an Islamic digital finance platform. What is unique about Islamic finance? We have discussed conventional financing, where you can finance your business with bank loan, bond, debentures. You can finance your business with overdraft. All this financing will be categorized under conventional financing. Or we can say interest-driven financing. We now have Islamic finance, otherwise known as non-interest finance. Finance a financial system that is not driven by interest payments. Islamic finance is a financial system that is based on adherence to Islamic Sharia law. It offers services, products, and instruments based on compliance with Sharia principles. This finance completely prohibits payments and acceptance of interest on lending or borrowing. Islamic finance completely prohibits the payments or acceptance of interest either for lending or borrowing. Under Islamic finance, money is not regarded as an asset possible to earn direct interest loan, they will now collect interest. Money is viewed as a medium of exchange, not an asset that can be used to generate interest. Now the question will now be, how does Islamic finance operate? If you are giving customer loan, you are giving customer credit, and you are not collecting interest, how would the company make profits? How would the bank generate profits? We have different Islamic finance products. Let's discuss this quickly. We have Musharaka, an Islamic finance product. This product is based on profit and loss sharing partnership. Musharaka financing is an Islamic finance product that is based on profit and loss sharing principle. And it is the most authentic form of Islamic finance. Musharaka financing is a contract of joint partnership where two or more parties provide the capital to finance a project or to own a real estate, either on a permanent or diminishing basis. Under Musharaka, the bank is also a partner. The bank and the customer will contribute money to finance a project. The profit or loss arising from the project will be shared between the partners. Profits are distributed between the partners in accordance to pre-agreed ratios. And where loss is sustained or incurred, this loss will equally be shared between the partners. In this case, nobody is collecting interest. If you approach Jaiz Bank to take a loan, they will ask you, they have different products. Should we go into Musharaka contracts? The bank will provide part of the finance. The customer will provide part of the finance. They will now finance the project. Where profit is achieved, both the bank and the customer will share. Where loss is incurred, both the bank and the customer will share. Number two, Mudaraba. Mudaraba Islamic Finance Products. This is an Islamic financing that is based on profit sharing and loss bearing. It is based on profit sharing and loss bearing contracts, whereby one party will supply the finance needed. The other party provide effort and management expertise with a view to generating profits. The bank under Mudaraba, the bank will provide you with finance for the project. Then the customer will go and execute the project. The customer will put in his effort and management expertise to execute the project with a view to generating profit. If the profit is generated, this will be shared between the capital owner, the bank, and the customer. Where profit is generated, this will be shared between the bank and the customer. Based on agreed ratio. But if a loss is incurred, only the bank will bear the loss. If a loss is incurred on that business, it is only the capital owner that will bear the loss. The managers will not bear any financial loss because it is believed that the manager has lost the time invested in the business, the time and effort invested in the business. That is Mudaraba Islamic Finance Products. Mudaraba is more like equity financing, whereby the shareholders will provide the fund and the directors will manage the business. The directors will put in their efforts and management expertise. Number 3, Muraba Islamic Finance Products. Muraba Islamic Finance Products. This is a Sharia compliant sales transaction. Muraba Islam is a Sharia compliant sales transaction, mostly used in trade and asset financing. Under this method, the bank purchases the goods or the raw material, deliver them to the. Foreign payments to a date agreed by the two parties. For example, I have a bakery business. The bank can purchase this machine for me under Muraba financing. The bank will purchase the machine or the raw material, deliver this to me, the customer, deferring payment to a date agreed between the two parties. The expected return on Muraba is usually aligned with interest payment. On conventional loan, the customer will be expected to make repayments at agreed date with certain percentage of returns. Then number 4, you have Ijaro. We are almost done. Ijaro is a contract of sale of the rights to use an asset for a period of time. Ijaro is essentially lease contract, a leasing arrangement. A lease contract between two parties. The lessor, the owner of the asset, and the lessee, the user of the asset. The lessor will provide the asset for the use of the lessee. In return, the lessee will make lease rental payments. So Ijaro is a means of finance. It involves a leasing arrangement between two parties, the lessor and the lessee, obtain the use of an asset in exchange for we have the sukuk. Let's go on. We are almost rounding up. Sukuk is an Islamic equivalent of bond. That are similar to asset-backed securities. Company willing can issue sukuk. Government can also issue sukuk. Unlike conventional bond, sukuk constitute partial ownership in receivables. Unlike conventional bond, there is a promise to repay. Under sukuk, is partial ownership in receivables. Government issues sukuk to finance road construction. Government will source money from the public under sukuk bond to finance different projects. Project of public interest, like road construction. What is partial ownership in receivables? Is that if you finance your business with sukuk, you are issuing a bond instrument, an Islamic bond instrument. The investor will subscribe for the bond. You are going to generate the money. To finance the project. You are not expected to repay the loan. But you are going to be giving the investor certain percentage of returns. It is usually used to finance asset-backed securities. There must be an asset. Like the road construction now, there's an asset. Unilag can decide to issue sukuk to construct hostel for students. University of Lagos can decide to issue sukuk to generate funds, and the purpose is to construct hostels for students. These hostels will be rented out to students. Money will be generated. Whoever invested in the sukuk are the owners of the hostels. Providing hostels for the students is of public interest. Now, when we generate money from this hostel, certain percentage will be used for maintenance. Certain percentage will be distributed to the investors. The loan will not be repaid. The concept of Islamic finance is that it's a pivotal of growth. People. Let's round up. Please note, Islamic finance can only be used for ethically acceptable product or service. You can't use Islamic finance for alcohol business. That business under Islamic principle, alcohol business is unethical and is injurious to public health. Islamic finance cannot be adopted for alcoholic business. You cannot use Islamic finance for gambling business, the like of Naira Bet or Baba Jebu. It is believed that gambling, Naira Bet, is an unethical business that exploits the people. So these are some of the differences, assuming you have to compare. Under conventional financing, you can take any business, provided it is not against the law. But under it, we look at finance success. We look at equity financing, debt financing. Under debt financing, then we discuss Islamic financing. Next week, we shall be putting question to this. Any question, clarification, we need to step out of the classroom.